Episode 572, Trading Justice Podcast, coming at you on an Easter Sunday. Price of chocolate has prohibited the celebration of chocolate bunnies.
No more bunnies.
You don't get bunnies anymore. Cocoa's up higher than the video. You know, we're going to do a first quarter recap here, Matt.
True statement.
It is a true statement. We're going to do a first quarter recap. We could put the cocoa chart, but we won't. It will just depress. But happy Easter to you, brother. How are you doing today?
Happy Easter to you as well. Excited to be here with you to record another edition of the podcast. And as always, just happy Easter to all our listeners. The pro members of Tackle Trading, love you guys. Hopefully you had a great weekend with family and celebration.
Yeah, I know, a wonderful weekend to celebrate faith, celebrate time with family. Hopefully you have some memories that you were created. We're going to do a different little twist on our podcast this week. We are starting on Monday, April 1st. So get your April Fool's joke ready. I got mine ready for my cash flow Vikings already. I'm gonna,
good one.
You know, I'm gonna pretend to buy some stuff that I don't believe in.
Boeing. I should start the halftime report.
You should.
Guys, let's break down a bullish analysis on Boeing.
But we're starting the second quarter. We're ending the first quarter, and it was one for the record books. A level of consistency in the S&P, price appreciation, some of the numbers, and then we're going to do a little look ahead at the second quarter. You know, give our take of where we see different assets potentially going here. But Matt, before we get started on looking at some charts, breaking down some numbers, what were your top stories for the first quarter? It was a memorable quarter. For sure.
It was. And, you know, honestly, any quarter you look back in the market for 3 months and there's 1,002 different stories that impact price. There's so many different stories of the financial world. One of the reasons I feel people struggle learning how to navigate the financial world is just there's so much information that comes into the market on a day in, day out basis. So then when you think about what are those big storylines that drive the market over the last 3 months? They're obviously all going to be some degree of macro oriented. But I listed out 5 different storylines that have been dominating the market for the last 3 months. The first one is the Fed interest rate cut expectations. If you'll recall, Mark, at the first of the year, the market had 7 to 8 interest rate cuts projected for 2024. The Fed had 3 interest rate cuts. The entire saga so far this year has been the market coming back in line with where the Fed is. The Fed was 3 to start the year. The Fed's still at 3 as we talk right now. The market over the course of the last 3 months have came back down in line with where the Fed is, right at that 3 interest rate cut expectation. That 3 interest rate cut expectation has driven so much price demand. It's been fascinating, Mark. It's rinse and repeat. Every CPI day, every PPI day, every PCE day, every labor market day, every Fed day, we rinse and repeat the exact same storyline. The market is now only expecting 3 interest rate cuts. What does this mean? It means markets go up. That's what it means. And so it's been a fascinating saga over the course of the last 3 months, but I'd say Fed interest rate cut expectations, number one. What's your thoughts?
Yeah, no, I mean, you know, this is one that on the podcast prediction show, we thought the market was ridiculously, no, it's like they're not doing that. That's too many, too fast. They were really pricing in inflation, making a straight line to 2. Is essentially what the market was doing at the start of the year, and that was not the way this was going to play out. And that's just kind of had it. I mean, it probably got more airtime, more press time than any other story, just in totality, didn't it?
Agreed. The second one, double dip inflationary concerns with the potential resurgence of inflation in January, February, and March. Real simple story to understand. The market a year ago had 9.5% CPI inflation. Today, that number is slightly north of 3%. So we're on a long trajectory down to that 2%. But in that long trajectory, you have bumps in the road. And sometimes those bumps become hills that become difficult to navigate. And right now in January, you saw a slight bump up in inflation. Even I, which I'm an inflationary hawk, even I discounted that first bump up in inflation because of the strength of the longer term trends. You could easily discount one misstep. Even in February, there was a bump up in CPI report, in the PPI report. That was a little bit concerning. But then in March, you had the PPI report, the CPI report confirmed yet again the slight elevated rising inflation. And then the PCE report this last Friday, which basically came in line. There wasn't nothing really to update in the PCE report, but one data point from an inflationary perspective that will go into the inflationary resurgent concern category is retail spending was up 0.8%, expectation was 0.5. And so I would say inflation resurgent concerns, obviously, anybody that listens to this podcast knows exactly where our head's at from a double dip inflation concern perspective. But the market is seemingly embracing this one a little bit as well. Gold would not be doing what it's doing today if there was not some general mentality there. What's your thoughts on inflation resurgence?
Yeah, no, this is one of those that the story of this quarter, Jay Powell can brush it off. I mean, even on Friday in Powell's speech, right? Markets closed. He has an interview, basically, just there's certainly no concern issued by the tone of his voice, to say the least. I think we would look back at this quarter as not just a first quarter story. I have a feeling we're going to look back at this quarter and be like, yeah, that was a story in 2024.
Yeah, I feel his press conference from the last speech will go down in history in the same way that transitory did, and Ben Bernanke's basically statement in February of 2008 when he said there's no threat to the subprime market and everything looks pretty hunky-dory out there. The automobile sector is fantastic. Remind people 6 months later, the subprime meltdown occurred. Lehman Brothers is belly up. Our financial system is completely shot, and they had to inject trillions upon trillions of dollars just to stave it all off. And so I obviously have concern, and I think the central bank's making a mistake. But at the end of the day, we're just talking about the market stories. The third one, Mark, Magnificent Seven separation. And what I mean by this one is when you think about 2023, 2023 was the year of Mag 7. It was the year of AI. And it was, you could pick any stock in Mag 7 and you did fantastic. That's not the case any longer. This is not just a Mag 7 market. This market has other aspects to it that are doing really, really, really well. For example, cyclical areas of the market have been utterly dominant in the last couple months. But in 23, it was just Mag 7.
Yeah, Matt, I have gotten the biggest kick just in internal conversations and seeing little things out of you basically saying, oh, CNBC finally commented on energy. Oh, mainstream media is finally commenting on finance being up. Like,
it's amazing. It's amazing how much they talk about Mag 7, Bitcoin, and those types of asset classes, but they don't talk about energy at all. They don't talk about industrial law. They don't talk about finance.
When it seems like everything has had a turn this year, hasn't it?
Not only has everything had a turn, the ones I just said are the most consistent year to date. By far, they're the most consistent year to date. But what's interesting to me, Mark, is Magnificent Seven in 2023 was the storyline all year long, as well as AI. Obviously, AI was dominant in that conversation as well. But in November, December, you started seeing that change. And now as we look back 3 months later, this market is not a Mag 7 market. This market is dominated by cyclical components right now. Obviously, AI is still hot.
This market is a bull market.
It's a bull market. You're absolutely right.
Which means, as you always say, what is the hallmark of a bull market?
Consistent sector rotation.
Yep.
And that's what we have seen. What we haven't seen is after a sector gets done, it doesn't sell off. But that's a slightly different
but I want you to spend 30 seconds, a minute on this, because you were talking about this in pre-production. I think it is such a stellar point that in previous rotation, how is price action in previous rotation versus what we've seen this year?
We talk sectors.
Okay, fair enough.
We'll talk sectors here in a second.
Because I think it's an amazing point.
Yeah, I think it's an important data point that we need to discuss. But Mag 7 separation is something real And it's been fascinating to see other areas of the market step up to the plate and take on some bullishness here. This year, Mark, has been interesting in the sense that, yeah, Nvidia is still great, Meta is still great, but outside of that, and Microsoft's still great, but outside of that, you got Apple that's tested a low point. You've got Google that tested a low point. Tesla can't carry a bid yet. You've had a lot of separation here. It's been fascinating to watch. Number 4, the AI impact on markets. It's slowing down a little bit right now because it had a fantastic last year, a lot of price appreciation. This to me is going to be a 10-year saga. It was dominant in the last year. It was dominant in the last quarter. It's going to be a dominant story moving into the future as well. And then number 5, I don't think you can tell the story of the last 3 months of the market without talking a tremendous amount about the Bitcoin ETF launch that occurred in January. That was a 5-year saga that came to a conclusion in January. And now we have a lot of ETFs that we can track and we can invest in instead of going directly to the crypto asset class itself. And that has been extremely bullish for Bitcoin's price appreciation and most likely continual price appreciation here. So that's what I would categorize as the top stories that impacted the market for in the first quarter of this year. Did I miss any?
Well, I mean, listen, it was so big. Like, when we go into our personal stories, I'm going to talk about Janet Yellen, but I mean, most quarters, like you and I have been doing this a long time now, right? Most quarters, if you get one main driver or two, with some answer, then you're lucky from a thematic. We had a lot of moving parts.
There's a lot of themes, but again, that's a good thing. That's not a bad
thing. Yes. Usually, bear markets are usually focused on singular themes.
And can we be clear on something? Simply because there's a lot of sectors doing good does not mean that equates in totality to a bubbled market.
No, and we are not in a bubble. There might be a stock or two that you'd be like, I ain't buying at that level.
There's certain assets, of course, but there are still tremendous opportunities coming from low points as well. So that's the top 5 stories, Chucky. Let's talk about the review of the indexes, the sectors, and whatnot. When you're looking at the indexes, Mark, the S&P, the Dow Jones, the NASDAQ, and the Russell 2000, year to date, the first 3 months of the year, the S&P 500 is the number 1 index. It's up slightly over 10%. The Q's NASDAQ's up about 8.5%. The Dow Jones is up 5.5%, and IWM is sniffing that 5% level. When you're looking at the indexes, one of the things that stands out to me in the indexes is the consistency of the S&P 500. The
historic consistency
is the barometer of the marketplace, whereas the NASDAQ kind of focuses on one select area, technology. Dow Jones focuses on industrial, IWM, small and mid caps. The S&P is the barometer of all of it. It's got defensive, it's got aggressive, it's got cyclical. And I've never seen the consistency of a trend play out like this when you're talking about the indexes, because there's always something that occurs over time in a trend that will stop the consistency. The leadership will take a gut punch, for example. The leadership will have a negative news story. The leadership will have a negative earnings report. The leadership will have something negative happen. They'll go down and they'll bring everything down in the short term. But what's happened here, what's been absolutely amazing to watch the consistency play out, is when one area of the market slows down and takes a breather, it doesn't correct itself, which has been typical in other markets. When you talk about the 2013 and 2017 markets, for example, Mark, those were dominated by sector rotation models.
That's 2021 as well.
And 21, the same way this market is dominated by sector rotation. The difference between the 21, 17, 13 market and the 2024 market is the patterns that we see through consolidation. Oftentimes, when an area of the market has been trending really good and that trend gets over, it oftentimes will correct itself. You'll start to see sell-off, and as that profit-taking sell-off occurs, money rotates into another area of the market, and that takes a little bit of time. But what's happening here is the market goes up. And when you see consolidation, say, for example, out of technology, and you start to see technology consolidate, nobody is selling. They're just going to a different space. And that's what's different here is we're not seeing the sell-offs after extended trends the same way we did in 21, the same way we did in 17, the same way we did in 2013. And that lack of volatility in those areas of the market that are done, technology's been done with its trend mark for a month and a half, but it won't sell off. It just kind of hovers there, up and up and up. But it doesn't sell off. But what's been happening in the sense of the last month and a half is technology's been doing this little number here. Well, industrials, 45-degree angle up, finance, 45-degree angle up, basic materials, utilities is the best producing sector in the last month, for example. These quick rotation models have been really, really dominant. The question I have, and I think it's an open question for most market participants right now, first of all, I do believe indexing is back. The year 2023 was a stock pickers market. I still believe this is a stock pickers market. But when you look at the trends of the S&P 500 being one of the best, most consistent trends in the entire market right now, man, it looks fantastic. The question I have for you and for the market and for the listeners here is it's not a matter of if the Russell does great, the S&P's not. I don't think that's the case. But does the Russell 2000 start to play a little bit of catch up in the second quarter specifically? Because when you're looking at the Russell 2000, just to paint you a little technical argument here, the S&P all-time high pricing, doing fantastic. Same thing with the NASDAQ, same thing with the Dow Jones. The Russell 2000 is not sniffing the all-time high pricing. That's all the way up north of 2,400. Right now, you just broke out of 2,100. That's a mid-tier breakout. It's been an improving condition for the most part. Mark, year to date, we're only up 4.5%. A lot of that 4.5% is legitimately in the breakout of 2,100.
Just in the last little bit.
So my question for you is, do you feel the Russell 2000 plays catch up here? And how would you go about it?
Well, okay. So here, a couple there's a lot of thoughts here, right? A lot of moving pieces here. First of all, the S&P 500, if you are looking for the safest place to be, I don't know how it's not just from a safety, steadiness, S&P 500. I love what you just said there about the year of indexing, right? Because that's what this year has felt like. All right, just do I want to catch the trend? Do I not want to overcomplicate it? All right, let me just park money in the S&P, right? It's
the best trend in the market.
It is the best trend in the market. So I think as you approach the second quarter, it's not that you expect that to change. Of course, we'll be on the lookout for narratives, shifting technicals, all kinds of goodies, right? The things can change, yada, 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 standard disclaimer here. I think it's a mentality of do I want to go for overperformance? Or do I want to go for consistency, or do I want a mixture of the two? Because I think from a technical perspective, I think you can make a case on small caps on several fronts. One, first of all, you're just dealing with a multi-year breakout with upside potential, right? You're breaking through a resistance level. Multi-year breakouts on indexes should never be ignored. They are usually worth a play. And so just from that perspective, if you are in I think the economy is going to continue the trend. We have unemployment this week, probably going to show positive economic data this week, right? That's been the trend. Russell is very, very, it's hard to see a bearish environment of the Russell on a breakout if that's the case. And then on interest rates, right? Apple doesn't need interest rate cuts. Small caps tremendously benefit.
Great point.
Right. And so I think on the Russell, if you are looking for upside plays heading into the second quarter, the Russell, if you're looking for safety and boringness, S&P, I'd be surprised if the Russell, assuming the narratives stay the same, right? Assuming the narratives stay the same, I think the Russell outperforms the S&P. It doesn't mean the S&P has a negative quarter.
Well, it doesn't mean you're saying I want to allocate everything in the
Yeah,
Russell.
and nor does it mean that I want. And I think you can look at call
But
spreads.
I think what you're saying is you want a piece of this.
Yes, I think
you want a piece of this breakout.
I think call spreads are an attractive way to play it. Right. And for me, when I use call spreads, I'm talking more 3 to 6 month call spreads, not short-term swing trading call spreads.
Yeah.
Like, cause you don't want to be wrong that the Russell's going higher.
You don't want to get smoked out of a swing trade above resistance here.
But your timing was I want to, if there's a move here, I want to catch the move.
I always put it into time frame analysis, Mark. I don't think you look at this as a swing trader. There's certainly swing trades to be had here, but it's not how I would look at the space. I think you want some position analysis here. When you're talking about a breakout on a multiple time frame and you're talking about a position trade, I go back to the old Richard Dennis turtle traders people and trade that trend and let the trend kind of work itself out, but don't choke it off. Let it kind of work itself out.
I'm buying like one of my first moves, like based on preparation for this podcast. Every Sunday I meet with my Vikings, outline what I'm going to do the week ahead. One of the moves I'm doing Monday is buying a longer term spread on the Russell. Because if there's a move here, fix my risk, right? Fix my risk.
Listen, it could break, it could fake out. Anything can happen, but the reality is that's a good look from a technical perspective. And
I think you just have to, on principle, give it a shot.
Listen, mid-tier breakouts have a tremendous track record in recent history of getting into the 52-week high. And I do not think that is too difficult to do for the Russell 2000. All right, let's move on. Let's talk a little bit about the heat map here, Chucky. In looking at in kind of preparing for the recap conversation here, I got a screenshot of the first quarter performance from a heat map perspective. And I just want to ask you a question on the heat map, because we always look at a heat map to find what
if you would have told me, well, first of all, obviously there is a ticker symbol that stands out there.
There's a couple ticker symbols that stand out to me. But what stands out to you? What are the top?
If you would have told me at the start of the year, that we would be talking Apple down 10% and the most consistent trend in the S&P uptrend that we've seen in our lifetimes,
shocking.
I would have been like, that's an interesting
we can all send a thank you to the cyclical areas of the market for stepping up immediately when Apple stepped down.
Obviously, NVIDIA up 82% also is
that's kind of a standout. It's a big green box. It kind of stands out.
It's a big number.
Big green box. That box is going to be as big as Apple at some point, if not bigger. So they're going to have to make an entire space just for NVIDIA's market cap eventually. What stands out to me is obviously the same thing that stands out to you. Apple down 10%, knowing what the backdrop of the market is. But there's a tremendous amount of green out there, Mark. You got leadership in almost every space right now. Obviously, NVIDIA and Microsoft in technology, in finance, Burke B, JP Morgan kind of stand out. Pick your poison there. I'll take Warren Buffett's Burke B as a leadership if you want to take the JP Morgan devil. But like you can find Progressive Insurance up 30% this year is the best one in finance. Consumer cyclical, Amazon's obviously led the charge. Communication services, Meta's been a standout. Disney is absolutely a storyline in the
a lot of stories there. A lot of stories there on that heat map.
Oh yeah, consumer defensive, Walmart and Costco showing leadership. That's fantastic. Healthcare, Eli Lilly trying to make everybody lose some weight out there is obviously getting bigger. ISRG on their robotic AI bid is doing really, really good. Energy obviously is green across the board now after the last month. It's been a really, really good market so far year to date. I don't think it can continue this level all year long. I don't think we're going to be talking about a 40% year in the S&P 500. But at the end of the day, it's been a great start to the year. One additional thing stands out to me, Tesla. Tesla stands out to me big time. A big old red in a sea of green. Boeing stands out to me. Big red in a sea of green. Big red always stands out in a sea of green, and big green always stands out in a sea of red. So in terms of the heat map, though, my general takeaway is there's leadership in every space right now. This market is built not on the backbone of just 5 or 6 companies right now. And that's what the heat map really tells me. When you're looking at the sector analysis, Mark, and you can do this across the board on almost any time frame, from 3 months, 6 months, 12 months, 1 year, 5 year, technology is going to be the outperformer. I remember I've said this multiple times in the podcast before, but anytime anybody ever asks me what's going to be the best performing sector in the future, I'm always going to say technology, because 80% of the time I'm going to be proven right, or at least I'll be able to make an argument that I am right, because technology is always in that conversation. And in the first quarter, it certainly was. It was the number one producing sector in the quarter. It was up 12% in the quarter. That's a standout quarter. The problem for technology is they did a bulk of it from January 15th till February 15th, and they've been taking a little bit of time off since then. What's fascinating to me is the last 3-month performance of technology is up 12%, right?
Mm-hmm.
But in the last month, it's only up 2%. What has taken hold here? Energy up 8% in the last month. Basic materials up 8% in the last month. Utilities up 6% in the last month. Comm services up 5.5%. Industrial up 5% in the last month. That's what's fascinating to me when you look at the last month versus the last 3 months here is, yeah, the last 3 months tells the exact same technical story. When you look at it the last month, you see a rapidly increasing story for the cyclical areas of the market. What's your thoughts on, and again, the best performing sector in the last 3 months is technology. The best performing sector in the last month is energy. The best performing sector in the last day is utilities. That's a vast difference in sector analysis out there. What's your thoughts?
My basic thought is that's the most bullish analysis there is in the market, right? Like broad participation is critical for sustained bull markets. Now, this one's a little different in the fact that there's no pullbacks, right? It makes me a little suspicious and this and that, but that's just because I've never seen it before. It doesn't change the simple fact that consistency, broad participation, these are very, very bullish traits. Things that when they're not present, that's when bears are like, well, I'm not getting broad participation. And well, you don't have that argument.
It's not
right?
the case right now. Like this market has vastly broadened out from just the Mag 7 and the AI space that we were dominated last year till today. And specifically, Mark, as energy started taking hold in the last month, you started seeing a consistent bid in the cyclical areas of the market, to the point where when you look at Tackle Trading's rankings here, and I'm going to pull them up very quickly. We produce the Tackle Trading newsletter every single week. We gave it a new little look and feel this week in terms of the structure of the newsletter. If you're a pro member, definitely check it out. And if you're not a pro member, this newsletter will help you navigate the financial world, will help you understand everything you need to know going into the market next week, recapping this week. Love what this newsletter is becoming. Talked about market indicators, economic data, the takeaways, what reports to work for. But what I wanted to look at is the sector rankings here, Mark, because when you're looking at these sector rankings, there's only 2 sectors that are not in bullish territory. And those are 2 sectors that we rarely ever put in bullish territory.
Just not their nature.
It's just not who they are. They're not that type of space. And that would be utilities and real estate. Utilities is the number 1 producing sector, and it's still only positive 45 for us, because we live in the 40s in utilities and real estate. That's kind of a real bullish ranking for us on the utilities is a positive 35. It is. Like a positive 35 on utilities is like a positive 5 on technology for us. But when you're looking at the cyclical areas, which are the gold ones here on the chart, finance, industrial, energy, and basic materials are now all in line with one another, because they are right now running on the same algo program. And so finance, industrials, energy, and basic materials all are tied with communications for the number 1 sectors, all ranked right there at 20. Technology slightly behind it, discretionary slightly behind it, staples and healthcare slightly behind it. And so when you look at the current rankings of Tackle Trading versus where the last 3 months are, Yeah, technology can reemerge. Absolutely. In fact, I'll tell you exactly, if you want to pin me down, Mark, I'm going to tell you exactly when I think technology is going to be part of the bigger conversation for us. And it's after the second week of earnings, after we get Taiwan Semiconductor and Tesla's earnings.
Yeah, I mean, yeah, you laid this out in the pre-production, and I was like, damn, that makes too much sense.
Well, it's been taking a break, and it needs to
I
take
mean,
a
like
break.
seriously, you can't write the story any better. Take a break.
That's what makes sense to me.
Like consolidate, allow longer term moving averages to catch up. You get into earnings, you have positive things said, which won't be a shock, right?
No, they'll say positive things.
And all of a sudden it provides the leg for that next leg up.
It would be a beautiful backdrop for the technology trade to go through consolidation as it is going right now. Just continue doing that before don't start trending before earnings. Come on, market algorithm, Citadel, Virtue, whoever's the
come on, give
lords
us a
of the
break
market,
here.
just participate with me on this one. Give us a catalyst called the earnings, give us a breakout out of consolidation, and let us reignite on the technology front. But outside of that, like, you got consistent price action happening in almost every area of the market right now. I've categorized 4 sector trends so far, Mark, that I've been tracking. Number 1 is the technology slowdown. Number 2 is, as technology is slowing down, the cyclical consistency in finance, industrial materials, and energy. Number 3, defensive areas are starting to wake up a little bit as technology is slowing down. And number 4 would be what I call sector timeouts, which is basically that what technology is going through right now. Real good trend, go through general consolidation, let those longer duration moving averages catch up, and then let's giddy up and get ready to go again on that technology. So technology, discretionary, kind of going through one of those sector timeouts right now. That's what I got for a sector trend. What are your thoughts?
Yeah, no, I mean, listen, if we see in the second quarter more of the same, right? Because eventually cyclicals are going to take a break. But do they take a break? I mean, it's just, I guess, news at 11.
Do not guess that top.
Don't guess the top, but if you start to see that top look like technology has, S&P is like primed to go to 6,000. Because if when things take a break, they don't pull back, and then tech breaks out. Cyclicals take a break, and then
6,000 out there, like it's another day that ends in Y, huh?
Well, to be honest, it's like, what is that? Like only like 13% or something, 14%. I mean, it's not like it's a first quarter plus, right? Like,
yeah, but that's a market. It's not outlandish. It's not like, hey, I think Bitcoin 3 million, right? No, I'm just saying 6,000 is a big number, but no, it's not outlandish.
Dude, the old adage, when you break 5,000, you go to 6,000, right? Like, that's the old adage.
I think in this market, you could say that for any number and you would be right 90% of the time right now.
But the key is for the methodical consistency we've seen for that to occur, right? The S&P itself, I mean, one of the things, and you haven't heard me complain on the halftime report very much, because the trend's never got ahead of itself, right? You've never been like, oh my gosh, we're parabolic. It's
the consistency of support, Mark. Like, you're not seeing in the S&P, the weirdest thing is you're not seeing momentum. That's not what you're seeing. You're seeing consistency. And I've never seen it be that consistent this long. Like the amount of things you have to utterly not care about to be consistent that long in the market. Oh man, they got diamond hands right now. Let's move on.
All right, where are we going next?
Let's talk gold. Let's get into our major commodities and currency. That would be gold, crypto, and oil. When you're looking at the first quarter of gold,
I already feel bowled out from all the nonsense that I just said. And now we're talking gold. It's like, oh my goodness. Now I got to
we haven't even talked about the number 1 asset class yet, and that's Bitcoin.
Yeah, we haven't
these are what, if you're not bowled out yet, now you're getting into the things that are actually going up far more than the market is, and that's the commodity areas.
Well, we're going to talk cocoa now, right?
No, we're not going to talk about the 138% price appreciation cocoa currently has going on right now. Cocoa, they're going to, oh man, that thing is just absolutely insane. if you like chocolate and if you like
I,
candy, you need to start adding some to your 72-hour kit so you can pick from,
like,
because it's
yeah,
outlandish.
I'm not a big chocolate person, but man, I do feel, because there are people where that is their guilty pleasure, and yeah.
I used to not be a chocolate guy, and then I stopped drinking and I became a chocolate guy. That's kind of how it worked. But that's a very in-depth story that maybe I'll tell on the podcast one day. When you're talking about gold here, in the first quarter of gold, the first 2 months of it is me and Mark telling everybody to not get too concerned with gold not going up.
Mm-hmm.
The last month was me and Mark every day that ends in Y saying that was gold. And what was the difference? The difference was our inflationary message, the double dip inflation as it was starting to come out, and how gold was just being so consistent in price action. Mark, gold is an asset class, and for the year-to-date price performance, I used ETFs. I didn't use the commodities. I used the ETFs itself, except Bitcoin. I used spot price on Bitcoin. GLD is up 7.6% year-to-date. That does not tell the story of what is happening in the gold areas of the market. Now, Mark, what is driving gold? Let me just list out a couple things, and you tell me if I'm missing anything that's driving
All
gold
right,
right now. I'll just ask you.
I'm already laughing. I'm like, you don't have enough space on that PowerPoint, brother.
You listen. I will make it smaller, so I will add space. But inflation. Is it driving gold? Yes or no?
Yes, that's a positive tailwind.
Debt burden of the United States of America and the refinancing specifically of that.
Yeah, the debt crisis. Like even Jay Powell is saying this is an like.
Even Jay Powell went to Costco to buy 1 ounce gold coin, is what Mark said.
Like, no, I mean, yes, this is a massive tailwind for gold.
Okay, portfolio protection.
That's a classic. Any month that, that has more
similar
than 20
to my puts, it's a classic.
Yes.
Currency protection.
Yeah, of course.
Geopolitical uncertainty.
Yeah, we're not breaking out kumbaya and world peace anytime
Storage
soon.
of value. I just wanted to throw.
Yeah, I mean, yes.
Anticipated rate cuts.
Yes.
I can't go on. The open question I have.
What about central banks hoarding, right?
Listen, I didn't go in. I went into the known events that I could prove. Are central banks hoarding at levels higher than ever? Yes, yes, and yes. I'd like to ask the Bank of International Settlements what they have plans with their gold, quite frankly. Question for you. Will gold continue its recent surge?
I probably the least favorite question you're going to give me in this podcast, right? If I had to bet, yes, because of one simple factor, people are massively underweight gold, right? Like somehow all of a sudden the story is like, yeah, and once again, this is one of those late to the party financial media, other blogs.
Wall Street's late to this party.
Yeah, they are massively underweight gold.
You're not talking about retail. Retail's underweight too. Everybody's underweight except tackle trading.
But funds are massively underweight gold.
Yeah, funds. And I just wanted to be clear on that, because usually retail side is actually a little bit quicker on this gold conversation than Wall Street is. Wall Street's usually late to this party. I think Wall Street's joining this party. What's your thought?
Yeah, and so like, just the trends, Wall Street is not the brightest, quickest, but they sure as heck know how to pile on. Oh, yeah. Right. Just look at stocks over the last 18 months. Historically underweight heading into 2023, and then pile on. And where do you think gold is? They are historically underweight on gold. They don't want to miss pieces of things and aren't afraid to continue to chase. In their view,
what happens if something bad happens out there though, and they start losing money on equity? They might have to chase other asset classes. Gold is one of those asset classes. I think gold's doing good things in the face of historically not doing good things in that data. Gold historically does not do good in an improving economic condition. That's what we're having right now. And yet gold's doing good. Gold usually doesn't do good when the Fed has to update the market on their rate cut expectations, and yet gold's doing good there. And so gold's doing good in the face of the dollar right now, and improving economic condition, a parabolic uptrend in the market that's the most consistent. If you were to tell me any one of those three things were to exist in the first quarter, I would tell you if gold goes stagnant in the first quarter, I would take that as a win. And yet gold's up stinking near 10% in the quarter. I think it's fantastic.
Yeah, I think the market is certainly on the Fed doesn't care about inflation. We need to
I
do
think gold's
something.
undervalued. I just wanted to be clear on that. I think gold's undervalued right now. All right, oil here, Mark. Second to last instrument here. Oil, unlike a lot of the other instruments, took its time to get cooking a little bit. Fought a long-term reversal underneath. Was fairly choppy all the way from that low point up until the mid-tier mark. When you're looking at oil, oil is up an impressive 18% year to date. It's better than almost any sector out. It's better than any sector out there. It's better than any index out there. It's doing amazingly well.
A sneaky snap, right? A sneaky stat does not feel like it's up 18% this year.
Because we see so many other parabolic uptrends in the market right now.
And this was just fighting from the bottom, fighting through moving averages, fight.
So what's driving oil? Global economic growth, OPEC plus commitment to oil cuts, geopolitical uncertainty, and slight inventory drop in March is what's driving it. Mark, the open question.
That's a pretty good fundamental backdrop, right?
I think it does for oil. I think it does. As long as OPEC and specifically Saudi Arabia is committed to cuts, I think you have an argument. No doubt about that.
Yeah. And now you have the technicals. All right. Open question.
Open question I have for you, my friend, when it comes to crude oil and this recent charge. Because if you answer affirmative to this question, I'm going to have a very positive opinion of energy in general. When you're looking at crude oil here, you got a really good breakout out of that 80 level recently. That's the mid-tier breakout that we was the same breakout level we were talking about in the Russell 2000. Oil did that just a week and a half ago. Yeah. It spent the last week consolidating above that level without showing up too much volatility. Now you're talking about another breakout type situation here. Will oil hit 90 in the quarter?
Well, if I have to bet, yes, absolutely. I mean, just because the story, the technicals, sometimes technicals are telling you a story, and sometimes they're telling you huge stories. Like gold, the first 2 months of the year, right? It was telling you a story. It wasn't going anywhere.
Gold stabilization above 2K was a massive tell.
It told you a story, and that story is now in following chapters. The fact that oil was able to fight through so consistently, because if you don't know moving averages, oftentimes what can happen is you come up to a moving average after bearish conditions and get slapped down, right? And then you have to start the process all over again. That didn't occur here. You fought, you held, you grinded. Very impressive tell. Just that alone would say, yeah, you're heading to 90 this quarter. Now, of course, I don't think, this is an election year and the Biden administration is going to do everything they can to keep oil down. I don't know if they can because of that macro story and that technical story, right? They can wish, they can hope upon a star.
I kind of feel that'd be like Biden getting in front of a Mack truck,
but
Mack truck's odds.
And so I think there is certainly a case for oil. There's certainly a case for energy stocks, which just.
All right, let me ask you a question. Who has the greater ability to control price? U.S. opening up oil reserves in combination, not oil reserves, but opening up pumps. The U.S. is pumping more oil than they have at any point in human history. They're the number one oil producer in the world. The U.S. can even go further than that, much further than where they're currently at. It's a very positive thing to say we are producing more oil at this point than we ever have in human history. We're the number one producer in the world, even surpassing Saudi Arabia right now, and we still could open it up quite a bit here. So who do you trust more to control the price of oil? Because I do agree with you, Mark, that at levels higher than ours, there's people trying to control asset classes.
Yeah, of course. I mean, that's
And certainly the Biden administration does not want to see a double dip inflation take hold in an election year.
of course
And
not. Who would?
certainly in a double dip inflation, they do not want the headline of gasoline out of everything. If there's two things they do not want the headline on inflation, it's eggs and it's gasoline. Those two. And so Saudi Arabia fully committed to their cuts, though. But who do you trust more to control the price of oil? Saudi Arabia with their cuts, or the Biden administration through Yellen and opening up oil?
Yeah, well, Saudi Arabia, because they're closer to the source, right?
Yeah.
You know, they have more direct impact, right? And plus,
Well,
it's just a good fundamental backdrop story. And so,
Biden couldn't do what he wants to do because of certain people in his party. He'll have to talk that down, even if he does open up oil pumping.
I mean, you've heard me joke on the halftime report several times over the last month or so. Janet, you need to short now. If you're going to get this, you need to short now. It's probably too late. You're probably going to have to deal with higher prices here.
Well, yeah, I'm going to have to go ahead and agree with you. I think 90 is a magnet up there right now. It's like pulling price up to 90. 90 is a major pivot point. I've seen some outlandish projections for oil in the next 6 months, Mark. And oil and energy does have positive seasonality throughout April into mid-May. And it's got real good positive seasonality in April and mid-May. But I just can't see it above 90. I think 90 is kind of my number here. I've seen outlandish projections at 100, 110. I've seen people talk about 120. I just think 90 has to be the conversation. So I'm going to answer affirmative to that as well, Chucky. The last one is Bitcoin.
Yeah, and then one last thing on oil, markets and economy can withstand, $90 oil. It can't. There is a point where it starts to become a macro story, though, right? The higher you
100%. No, so it's not a macro story between 80 and 82.
It's not a macro
but
story.
But it's a macro story if it goes from 70 to 90 in 2 months.
And it's a macro story if it goes parabolic.
I think it's a macro story already. I think it's already impacting people.
And so, if you want to have a chart that I still maintain, I've maintained this for a long time. It's the only hedge that works in the market. If you want to hedge against your bullish things, that's the number one thing to have is oil. If I have all these bullish and
I would say gold has a fairly strong argument than oil.
These charts we're looking at right now, basically.
I would say if you wanted to bet against the market, I would bet on double dip inflationary asset classes, gold, oil.
It is such a better bearish bet than trying to short the S&P or whatever, because you can win both ways.
Well, I was talking on the bull side. I would never put gold into. I wouldn't even put it into the same sentence as bears or shorts or anything. Mm-hmm. Okay, what's driving Bitcoin? Bitcoin is by far the most impressive asset class in the quarter. It's up a whopping 67%. It is amazing to behold what is happening here in the Bitcoin areas of the market or crypto areas of the market. What's driving Bitcoin in the quarter? Obviously, you can't tell the story of Bitcoin in the last quarter without talking about the early January approval from the SEC on the ETF approvals. We now have multiple ETFs that is driving institutional demand at levels we've never seen. So you've seen institutional adoption, retail investors, massive demand equations for Bitcoin ETFs, Mark. And now that you got ETFs, you got to be talking about those ETFs in retirement funds and automated investing and so on and so forth. My question for you is, before we get into the ultimate question on the halving, what's your thoughts on Bitcoin in general right now?
I have been a believer since I started seeing the institutional adoption theme. It just made too much sense that if institutions are going to start treating Bitcoin as a mainstream asset class, that you were going to see price appreciation. It's simple, not a complex thing, right? And then obviously we have seen that. We have seen that now start to go into overdrive. Doesn't change the simplicity of the nice thing. right? That's still there. I still think you have much, much higher prices over time. That's what I need in an asset. Now, how do you tactically play after a 67% climb up, right? Well, that's, we break that kind of stuff down in shows and in the halftime report and all that all the time. But that institutional theme now is mainstream. Doesn't make it any less powerful, doesn't make it any less true. It is just now more widely accepted. That's a good thing. That's a good thing for Bitcoin in general.
I agree, Mark. In general, I agree. I also think Bitcoin needs to be on the radar, and it's not a clean technical conversation right now. But what does clean up technical conversations is either a deep sell-off or a clean high base breakout against.
And I think that's where you're at with Bitcoin.
Pivot.
Yeah.
And with Bitcoin, you're right on that. You're saying, give me a clean, like on IBIT, I think the cleanest handle is the 42 handle on IBIT. You clean up an IBIT 42 handle, you got a really good breakout there. Underneath the price action, it's just, there's too much nonsense, too much chop. So it'd have to be something a little bit deeper on any Bitcoin sell-off. But in a momentum condition, you want to first track the momentum before you track the sell-off anyways. My open question on Bitcoin is, there's a halving coming up on April 19th of this year. Bitcoin, from the very creation of the first coin in 0809 to today, the algorithm is designed every approximately 4 years to go through what's called a halving. What that means is the Bitcoin miners who mine for coins, how many coins they get will be cut in half, otherwise known as halving. So, for example, the first Bitcoin halving was in 2012. And they were pulling 50 coins. Think about this back in the day. Miners were pulling 50 coins, 50 coins. Guess what you get now? You get like 3 now. And so you went from 50 down to 25. Then you went from 25 down to 12 and a half. Then you went from 12 and a half down to like 6.17 or 6.25. And so now you're going through another halving. And let me get my numbers right. The halving now, the fourth halving is expected to be on April 19th. And it's supposed to go from 6.25 Bitcoin down to 3.12 Bitcoin. Now, Mark, my question for you is, will the April 19th halving have a major impact on the value of Bitcoin? And if it does, will it be bullish or bearish, in your opinion?
Oh, I mean, this is a tougher one than it seems on face value for a contrarian thinker like me, because those stats are mind-blowing, right? So, supportive of those stats, let me start with the contrarian. I'm like, all right, if everybody knows something, if everyone knows that, can it have the adverse short-term effect, right? Nothing long-term. Long-term, this thing's going on. It just is.
You are making the assumption that everybody knows the stats.
I am making that assumption.
I would argue with you that even Wall Street doesn't know certain stats.
So Bitcoiners know that stuff.
What percentage of market participants know what a Bitcoin halving is?
Very small, probably.
You first got to determine that before you can determine if they know the stats.
Yeah, that's true.
I would just argue again.
That's a good counter argument. But on the bigger picture for me, the halving is a reminder of a limited quantity asset in a world where you have fiat currency running amok.
One reason why people support it over fiat.
Yes, like, you have fiat currency and the insane debt things where it's like, this is just silly.
For example, let me ask you a question. What if the United States Treasury was forced to reduce supply every 4 years? Would that control inflation in the United States? Because that is exactly what Bitcoin does. Like, exactly what Bitcoin does. So it's a pretty good argument.
Oh, that's a Janet Yellen's head just exploded.
Janet Yellen's like, stop talking.
She's like,
Like, what do you mean? You have to cut supply of the M2 rate. How is that even possible? Yeah.
No, and so it is it's one of the halving is one of, and I like the point there about, like, how many people actually know that, right? Because if it is like, because Bitcoin's just a baby asset, right? I wonder how many fund managers, if you pulled them on how many could even get that right? Like,
what type of managers?
Fund managers, right?
I would say less than one.
and so like,
I'm dead serious. I'm not being facetious. Less than 1% of fund managers could specifically tell you exactly what a Bitcoin halving is, including how often it occurs, what the levels were, and what happened to Bitcoin afterwards. I would say less than 1% of Wall Street fund managers know how to answer that question.
yeah,
And I think
well,
I'm being generous.
if that's even
The average fund manager is 55 pushing mutual funds that don't even know what's in the mutual fund, let alone what a Bitcoin asset is, let alone what a halving of that Bitcoin is. They don't even know how the currency of the United States dollar is created. Why are we giving fund managers any credit?
Yeah, I know. So yeah. So does the halving, and what's my time period here? Like, does it have a positive impact? Like over time, of course it does.
No, I listen.
This quarter?
Answer the question however you want to answer it.
This one's a hard one.
You're skating though.
Yeah, this is I'm wiffle waffling, doing my best.
Big time. Is the thing that you're struggling with the massive price appreciation?
Yes, that is what the core is. Like when you're up 60, when you are a major asset class and up 67%, I'm a huge believer. You need time to digest.
We both agree that Bitcoin in the 14 years of its existence has had massive upwards increases in price many, many, many times.
Yeah, so we
because it started at zero, right?
Yes, we've dealt with these swings before.
All right. When in the first halving, and I'm gonna read you some numbers. So let me get them exact. In the first halving was in 2012. Bitcoin before the halving was $12.30. After the halving, 1 year later, was $964. Okay. Massive price appreciation. All right. The second halving, Bitcoin, that was in 2016, July 9th of 2016 specifically. Bitcoin's price was 663 after that, or before that. 1 year later, it was $2,500. Not the same price appreciation, but a pretty big movement in price.
No one's going to complain.
Bitcoin, third halving, 2020, May 11th to be exact. Price before the halving, 8,500. Price after the halving, just a couple months later on this one, $69,000. A whopping 700% price appreciation in 2 to 3 months. 3 out of 3 of massive appreciation between 2 to 12 months from after the halving. Obviously selective dates, okay? But there is a rich history of price appreciation after the halving. The halving is known as bullish analysis.
No, I think, well, if you assume that this is not a widely known thing, which you have convinced me that it is not,
I don't think
you got to bet.
in the Bitcoin market, for people that know Bitcoin, yeah, of course it is.
Yeah, I mean, I think that's the hang. I was like, everyone in Bitcoin knows this, right?
But Mark, the argument you were making was not.
It was not.
Tom from down the street who bought Bitcoin in 2015 knows it. Of course, Tom from down the street knows it. Okay, we were talking the institutions.
Yeah, Tom knows it really well.
Tom and Jerry know it. They both know it.
All right, higher, dude, is higher. Play the breakout. Play the breakout.
All right, Chucky, appreciate your thoughts today. The last thing I wanted to do in the podcast here today is just have both of us identify the 3 storylines that are most important to you, not to the market, but
from the first quarter.
Yeah, what fascinates you, interests you, concerns you, whatever it is. My top 3 are as follows. And I do have these listed in order of priority to me. Number 1, double dip inflationary concerns. I'm an inflationary hawk. I'm a central bank nerd and an inflationary hawk. And
these are subjects you historically know well. They matter to you.
Very concerned over the double dip inflation and the lackadaisical mentality that the powers that be have towards the double dip inflation. They are not talking the language that they need to talk right now in this environment. That concerns me. Number two, man, we've been talking energy at tackle and industrial at tackle and finance at tackle and basic materials at tackle for the last couple months, Mark. Everybody else in the financial media seems to be wanting to keep talking about everything known about technology. That has not been the trade lately. It's been cyclical domination as the trade. And as long as that cyclical domination continues, we're going to be on that freight train with that. It's just beautiful trends happening in industrial, finance, energy, basic materials. And you know what, Mark? We're late stage trends. We are. But we've been late stage in industrial for a month and a half. I'm not going to be the guy that says when that thing's going to top out. When it does, we'll see the double top and we'll see the shifting volatility and momentum. As of right now, it looks really, really, really good. And then the third for me was the Bitcoin ETF launch. You know, we don't talk about Bitcoin as much as we do gold. We love them both. I've treated Bitcoin as a tradable instrument in the past. I've treated gold as an investor instrument in the past. I wish I would have treated my adoption of Bitcoin the same way I treated gold, but I didn't. I made a choice. It was going to be a tradable asset for me. First trade I ever made on Bitcoin was October of 2013. You know, that's one of the things I wish I would have had a little bit different understanding of what that asset class was at the time. But 5 years ago in 2018, 2019, there were people trying to put together ETFs for Bitcoin, and the SEC just didn't want anything to do with it. For whatever reason, I don't know. Here's a 5 times leveraged financial asset class that you could also trade options on, which will give you the equivalent of 50 times leverage. Like legitimately, you could be trading the regional banks on leverage, but you couldn't get a Bitcoin ETF. That is the most ridiculous thing I've ever heard of. And so when the Bitcoin ETFs got launched in January, man, I thought there was going to be a lot of movement around it, both up and down. That's what it was. But I was caught off guard a little bit with the consistency that played out after the Bitcoin volatility declined, the ETF launch declined, and the consistency in that trend was just something really, really good. These Bitcoin ETFs, and again, we're still in the infancy of the Bitcoin ETF conversation.
This story transcends our lifetime by
absolutely. And so it's going to be a fantastic thing to invest in, trade, talk about. And
Kathy Woods is absolutely right. Bitcoin's going to million, like probably just a couple lifetimes from now.
Right? Listen, some of the outlandish projections on Bitcoin back in the day, I scoffed at. Kathy Wood's $500,000 comment, one of them. There's a few others out there as well. I don't scoff at those anymore.
Yeah,
do you?
No, not in the age of fiat recklessness. No,
not. And that's a great way to put it. The age of fiat recklessness. What about you?
One of my top stories was along your lines. And I know Janet Yellen's listed first there. Let me get to that. Let me get that second. But Jay Powell's complete dovishness this quarter, like his pivot in December kind of came out of, hey, we are going to be tough. And then one day it's like he got a tap on the shoulder. And then all of a sudden was like, no, we're going to cut rates. But his absolute steadfastness to that, regardless of Jay Powell, in the last couple of years, we have seen Jay Powell deliver tones of true. We are going to measure the data. The data is going to tell us. And while he still plays lip service to that, right? He knows the words, how to repeat them very well. His tone and overall dovishness has been remarkable in the first quarter. Like, just remarkable. Like he is sticking on script, right? Why is that the case? We could speculate, but that really stood out. And I think there's a reason gold finally said, screw this, we're going, right? I think there's a reason. I think Jay Powell's tone is telling the market, quite frankly, the inflation target's been raised. Has been raised.
You get no disagreement out of me. I've long held the belief that they were raising the soft target on Bitcoin. not Bitcoin, on inflation, and
they will never admit that
3%.
They will never admit that.
No, they'll change the calculation of the CPI report.
Yeah, they will never admit that, but they are obviously willing to tolerate higher inflationary levels. And
if I were to, okay, let me put it like this: if hypothetically the Fed had made the decision to adjust to a 3% target, every decision and speech Jay Powell has made in the last 3 months makes sense.
Makes sense. Makes perfect sense.
It does.
And I think markets understand this.
Mm-hmm.
And I think like even myself, I'm like, all right, if I have a 3% accepted inflation, which God knows how much actual inflation there is in that environment, I have to keep up in growing my money. Now I got to be careful and methodical and all of that, right?
You know what that means for our kids' generation of what they have to do to save for retirement, Mark?
Yeah, it's disgusting what it does.
You're talking hundreds of thousands of dollars in difference.
Yeah, no, this is
there's not a scenario possible where 70% of America will be able to retire based on an adjustment of a 2% to 3%.
I know it might not sound like, no, it's a huge, massive freaking deal. It's just it's sad. It's sad.
If the Fed's target goes from 2% to 3%, like, I'm just trying to think. That's the stated one in the report. What does real inflation feel like at that point? Like, because there is a real versus a report conversation here.
Matt, I mean, I was playing a video game, and for 20 minutes in the general chat, people were sharing tips with each other on how to save cost on food and still enjoy food to its fullest. That's a real life conversation that was being held in a video game where would be out of place, but it's.
I would say number one is never, ever, ever eat at McDonald's again.
Yeah, no, you can never. Companies that are producing less and qualifying less for corporate profits.
Mm-hmm. Which is happening. Like, I don't want to blame everything on how Biden called it shrinkflation. No, but it is happening that corporations are sticking higher prices on consumers with less quality simply because they now can.
Because they can.
And that's very, very unfortunate. And I wish we had a stronger arm of the government.
Until you tell those companies to go to hell, they will continue to do it.
You got to.
There's one way to do that.
There's an easy fix here.
Yeah, you don't have to go protest in the streets. You got to stop spending money with those companies.
Nope.
Right?
It's an easy fix. Well, you were talking, there's an easy fix from a consumer perspective, just stop spending money there. And I do agree with that. There's also an easy fix from a government perspective, but I doubt they have the.
No, and so his dovishness was just stood out from a historic, when I have to listen on Friday to 3 minutes of introductory remarks about how Jay Powell is a man of the people, how he is. They're fighting for the average person, and that consumes his I'm like, you people are the biggest gaslighters in the history of gaslighting. You guys are terrible. He is not a man for the people. Stop gaslighting. But no,
it's Easter Sunday. I'm gonna take the positive route.
Yeah,
the kind route today. Tough job. Stop lying.
Stop lying, stop gaslighting. So yeah, that's what the other thing, and this isn't going to get a lot of headlines and a lot of press time, but I just never am ceased to amazed at how good Janet Yellen is at her job. Like, she did a masterful job.
Mnuchin level for you.
Oh, Mnuchin was an idiot. Listen. First of all, I love Steve Mnuchin. Like I got a kick out of Mnuchin.
That's my opinion.
Steve Mnuchin's a freaking idiot. I like Steve Mnuchin. As like a human being, as far as an evil, skeezy Wall Streeter type guy. But he never really tried to do his job as Treasury Secretary.
He didn't really care about it.
He was there, and he's like, but
he was there for his wife to take pictures on.
Yeah, he wasn't exactly pulling the strings behind the scenes, right? Like,
he's like, let's get that picture over there. Come on.
I more like the concept of Steve Mnuchin than probably Steve Mnuchin itself, but the whole
Yeah,
different thing.
I agree.
Uh, uh,
Janet Yellen does bring
but
a
Janet
different level of
Yellen,
mastery to this, though.
like she is so
Steve
good.
Mnuchin could not do what Janet Yellen has done.
No, I don't know if anyone that I've ever known could quite do it. Like
Jay Powell, the current head of the central bank, one of the most, if not the most powerful person in the world, bows at the altar of Janet Yellen. We already know this.
She called oil's recent top, and oil went down for a couple months. She wanted lower yields, and whenever she has done such a masterful job of how she has. And once again, one could argue the long-term ramifications. I'm arguing for the net desired results. What she wants, she gets. Like she wanted lower yields, she wanted stable yields, she got it. She issues debt in a way.
The mastery you're talking about is
it's not necessarily good for all of us long term. Yes.
Yeah, you're not saying, ooh, like I want Janet to lead everything. No, it's like if Janet says she wants lower oil prices, she's going to do everything she can to create an environment to lower oil prices. If Janet says she wants to have Jay Powell change the tone at the central bank, she's going to go talk to him. And maybe it's just a matter of showing Jay Powell the amount of refinancing it's going to cost if they do. Maybe it's
I don't know if you caught this in Powell's speech, Matt, but Jay Powell was talking about his mentors and who he goes to for advice. And he's like, oh, yes, of course, former chairs, but of course not Janet Yellen because, I don't talk to her. Like out of his way, like how I don't talk to Janet Yellen at all for advice. I'm like,
that is the most ridiculous comment.
I think thou does protest too much, Mr. Powell.
Oh, Powell, you guys are both on the PPP team.
Like, you never go to Yellen because it would be a conflict of interest.
Oh my
God! Oh, you lying!
Be honest. That's the political separation of the central bank. There's a church and state mentality between the central bank and the government, and they don't want to show that there's coordination going on here because, Lord forbid, somebody has a theory going on Twitter regarding the manipulation of the economic or fundamental environment between Janet Yellen, the head of the Treasury, and Jay Powell, the head of the central bank. Let's just be honest. You two talk, you're buddies. You talk all the time. Janet gives orders to Jay. Jay says yes. That's how it works. We know the relationship. It's okay. Admit it. We know you talk. And you know what? It would be crazy for them not to talk.
It would be crazy for them not to talk. And so when
the head of the Treasury, the head of the central bank in an inflationary environment, we would criticize you if you didn't talk. That is why Jay Powell is a fundamental liar and does not want to tell the truth on these macro.
When he is going out of his way to say, no, I do not talk to Janet Yellen for advice.
Such a lie.
How am I supposed to believe anything else you say when you say that?
I'm sorry. If true, I think that's ridiculous.
No, he said it. Dude.
I don't believe it to be true, but if true, I think it's ridiculous.
Well, of course, Janet Yellen has him.
Is the central bank now leading press conferences and speeches based on Twitter polling?
Maybe.
It makes no sense for them not to talk.
I know, right? I know. But anyways, Janet Yellen's masterful...
Talking does not mean political pressure. My God, this is insanity to me. It's like our entire political world now. Republicans can't talk to Democrats. For what? I don't know, but we can't do it. You can't have the central bank talk to the Treasury. Why? I don't know. We got problems. We need to talk. Lord Almighty.
Like it was seriously. I honestly, it was like, I go to Ben Bernanke, but Jenny. Oh no, I don't talk to her. Like,
I'll go to Big Ben Bernanke to get advice. The guy who launched us on this ridiculous house of cards path from a currency perspective. Okay.
Yeah. So Jay Powell. He's just.
But I don't talk to the other.
He is just a paid actor. That's all he is. He is a paid actor. That is all he is.
Fan. I talked to Bernanke.
I talked to my fellow central bank heads.
In the middle between Bernanke and me, like whatever. Dude.
Yeah, whatever. Yeah. Your pivot had nothing to do with Janet Yellen.
But that's why America doesn't trust these people.
Nope.
It's because they lie over
because
the
they
dumbest things.
And if they're doing that, they're obvious. Yeah, it's just.
I tell my daughter this all the time, Mark. In life, you got to get the easy ones right. Because if you don't get the easy ones right, you're going to trip and fall over the hard ones. It's the easiest thing in the world just to say, yeah, I talked to Janet. She's the head of the Treasury. We have to talk.
Of course, I mean,
we
seriously,
print money.
Like,
and
why wouldn't you go out of your way to say, yeah, duh, I talked to her. She's the head of the Treasury. I'm the head of the central bank. Of course,
I guarantee some social media large following put out some conspiracy stuff about Janet and Jay converging their minds to kill all Americans or something along those lines. I totally kid there, but it's just ridiculous to me that we as Americans refuse to talk and refuse to admit we talk because of what some might criticize. You're going to get criticized just for walking outside. You're the head of the central bank, for crying out loud. You're one of the most powerful people in the world. You should have a little bit thicker skin to getting criticized online regarding communication with the powers that be when you are the powers that be.
Yeah. So it's ridiculous. It's like there's a reason we've had presentations on freaking buying gold and everything lately. These people are, anyways. But Janet Yellen is doing a masterful job at her desired results in the short term through debt issuance and how she's issuing the debt to outright lying about the amount of debt that would be issued in the second quarter. Like she's doing what she is manipulating markets at a Black Sith Lord high level. Like, it's impressive.
In your top stories, you just wanted to get all those like hot button topics.
My third big story is Bitcoin ETF launch. It was freaking historic.
It was historic. It was historic. All right, brother.
Like when the history books record the history of Bitcoin, there will be many stories. That is a historic moment that happened in the first quarter of 2020.
Well, with that,
I got you fired up.
Well, I again, get the simple ones right. That's a simple one. Like, who cares if you're talking? It's weird if you don't talk.
It's weird if you don't talk. The fact that you say you don't it should raise red flag suspicions on, oh my gosh, how deep is this?
Well, because we don't need to go on that because I think it's weird to everybody that it's like, wait, you say you don't talk.
You don't get advice from Janet Yellen.
You say you don't talk fully because you don't want people to think you talk. But the people are like, why aren't you talking?
Well, because of course you're talking.
Maybe if you talked, you might be able to combine your data to figure out the double dip inflation situation. But again, we'll save that for another podcast. Mark, send us out there, bro.
Now listen, it's a fun podcast. I really enjoyed that one a lot. It's going to be unemployment week this week. We'll break it on down day by day in the halftime report. Scout out those opportunities. There's an opportunity. It's a hunter's market right now, right? You can find good trades in a lot of different places. That's been the case for 5 months. I don't think it is going to cease this week. So come join us in the halftime report as we help you. What's the phrase we like to use? Bird dog for you. Find some of those great opportunities that are developing. We do like to bird dog.
My last thought, very simple. Coach Mark is putting together a wonderful, wonderful series on decoding Buffett, learning from the Oracle of Omaha, learning about his early development, how that influenced him along the way, the great investors and what they can learn from them. Mark, I know what you're going to be getting into in terms of understanding the fundamental conditions. I am so excited about Decoding Buffett, a new short series produced by Tackle Trading and hosted by yours truly, Coach Mark. It's a wonderful series. We got the first video out on YouTube. If you're interested in learning more about Buffett and not just from what everybody knows, getting into his story and getting into how we at Tackle Trading define some of what he is talking about in terms of intrinsic value, understanding intrinsic value, understanding your moat, you name it. Very excited about this Decoding Buffett series. Definitely check it out on the Tackle Trading YouTube. The first video is out. These are all going to be like 10, 12-minute videos, not long form, just quick hitters, understanding a little bit about Buffett week in and week out. It's called Decoding Buffett. First video's out. Definitely check it out. With that said, hope everybody has a wonderful week. If you need us for anything at Tackle Trading, you could always email us at team@tackletrain.com. And if you're looking to join up with Tackle Trading, you can always go up to the website and just hit that Get Started button, and you can sign up for a free 15-day free trial on Tackle Trading. You can test out all those goodies at Tackle Trading, such as the scouting reports, the newly minted Tackle Trading newsletter, all the different webinars we do, all the education that comes along with it. We believe in education before application, but we do a hefty dose of both in our community. So hopefully we can see you at Tackle Trading, but if not, we love you anyways. Have a great day.